Hello, welcome to all of you to this webinar on behavioral finance. This is Prasanna Chandra from Bangalore. I am delighted and honored to be with you this morning to share some of my thoughts on behavioral finance. Before I do that, let me wish you a happy Yugadi, which marks the new year in some parts of the country, including Karnataka, and I hope and pray that the new year will bring abatement from the COVID menace. In this webinar, I plan to examine the key differences between rational finance model and the behavioral finance model, the psychological processes and heuristics that we employ that lead to biases, the fundamentals of prospect theory and mental accounting, two central ideas of behavioral finance, and suggestions for improving investor behavior. Very simply, behavioral finance is rational finance plus psychology, sociology, and neurosciences. The rational finance model dominated the world of finance from 1950s onwards. It is based on a number of assumptions about economic agents. It assumes that people have stable and consistent preferences. People decide as solitary individuals. People maximize. People have perfect knowledge. People have unbounded computational capabilities. And people have unbounded willpower. Based on these assumptions about the nature of the economic agent, a number of important theories and models have been developed. The important ones are expected utility theory, proposed by von Neumann and Oscar Morgenstern, mean variance portfolio theory, developed by Harry Markowitz, capital asset pricing model, proposed by William Sharpe, efficient markets hypothesis, propounded by Eugene Fama and Paul Samuelson, standard life cycle theory, developed by Franco Modigliani. These have been seminal contributions to the field of finance. They have virtually revolutionized the field of finance and investment. No wonder Harry Markowitz, William Sharpe, Eugene Fama, Paul Samuelson, and Franco Modigliani went on to become Nobel laureates in economics. The rational finance model had a very significant impact on investment profession and the corporates. The standard model underlying modern investment practice is a combination of modern portfolio theory and capital asset pricing model. In the last 15-20 years, index funds have emerged as a very important alternative investment avenue. Risk-adjusted performance measures based on the rational finance model have become commonplace. Options, futures, and other forms of derivatives are now being employed extensively for managing risk. The principle of creating value for shareholders in a legal, ethical, and responsible manner has now been widely accepted. While the rational finance model dominated the world of finance from 1950s onwards, there were certain criticisms and challenges posed by behavioralists. The major challenges came in the following form. Many behavioralists argued that economic agents behave in a manner which deviates significantly from rationality. They believe that it is possible to beat the market. They found divergence between market prices and fundamental values. They provide evidence for excessive volatility and periodic booms and crashes, and they argued that markets often provide misleading signals to corporates. Before I examine some of the important contributions of behavioral finance, let us at this juncture pause for a while and understand why investors are rational. And before I do that, I would like to draw on my experience with the Indian markets in the last 5 decades or so. Uh, I'll talk about a few things from 1992 onward because many of you may not be fully familiar with what happened prior to liberalization. Most of you, I suppose, are products of economic liberalization. In 1992, UTI launched a scheme called the Master Gain Scheme. In that single scheme, it gathered 5,000 crore rupees. Earlier, UTI had great difficulty in garnering 100, 200, 300 crores in various schemes. But thanks to the euphoria that prevailed in the market from 91 onwards, the market reached very high level. And in a single scheme, UTI garnered 5,000 crore rupees. I can vividly recall that day when they had crossed 5,000 crore. I was in Mumbai attending a board meeting of an asset management company of UTI. The fund manager came and said, Saab, laddu khaiye, laddu khaiye. I said, what happened? He said, it is unbelievable, but we have gathered 5,000 crore rupees in a single scheme. I said, this is not a matter of celebration. When you gather 5,000 crore rupees, when the market P is close to 50, it will be a daunting task to provide a satisfactory return. And that is precisely what happened. The scheme wobbled along for the next decade. The markets after 94 started declining and they were wobbling. There was a TMT bubble in 99, 2000, 2001, and that also fizzled out. It's hard to believe that in 2003, the market P was 10, 11, 12, and the entire mutual fund industry gathered only 100 crore rupees annually. The market started soaring from 2003 and onward, and the most glorious period was 2003 to 2008 when the market rose dramatically thanks to the euphoria that prevailed in the market in 2007. Infra funds alone gathered 50,000 crore rupees. All those funds have done very badly subsequently. The point I'm trying to make through these examples is that investors behave in a very irrational manner. They go by just one number, the return earned by a particular instrument in the last 2-3 years. They simply extrapolate their immediate past experience onto the future. I may argue that in the last 25-30 years, whatever investments have been made by the majority of investors, whether they were stocks, gold, bonds, or mutual funds, turned out to be lousy. Where is the problem? As the legendary Benjamin Graham said, the investor's chief problem and even his worst enemy is likely to be himself. We are hardwired for financial failure. Why are we so messed up financially? Forget blaming our parents. Instead, we should probably blame our great grandparents, our hunter-gatherer ancestors. In the evolution of human sapiens, 99.2% of the time has been spent in the hunter-gatherer state, and our brains have been designed to cope with the environment that prevailed then. What was the primary objective. The primary objective was to survive and reproduce, and our ancestors consumed whenever they could because they were not sure of getting the next meal, imitated others because it was safer to be part of a crowd, constantly look for patterns such as signs of food and water, reacted swiftly to any whiff of danger, conserved energy, and explored the environment for newer sources of livelihood. This was the ancestral environment in which the human brain has evolved. There is a mismatch between the human brain which evolved during that ancestral environment and the current financial environment. Our brain is well designed for that environment which prevailed in African savanna 150 to 200,000 years ago. It is ill suited for the industrial age which began 300 to 350 years ago. It is even more ill suited for information age in which we currently live. According to a popular model, the human brain, called the triune model, the brain has three parts: brain stem, also called the reptilian brain. It is the oldest part of the brain, and the reptilian brain or brain stem is responsible for respiration, digestion, heartbeat, so on and so forth. These are autonomic functions which we share with the reptilian creatures. The second part of the brain to evolve was the limbic brain or the limbic system. It is also called the mammalian brain or the emotional brain. It evolved over tens of thousands of iterations, and it is in version 5. The last part of the brain to evolve is the rational brain called the neocortex brain or the hominid brain. It is the most recent addition to the human brain. It is in version 1. You can now see why our brains are not designed for the complex financial environment in which we live, because we have a very well developed emotional brain but a poorly developed rational brain. More often than not, emotions dominate our decision making because the emotional brain is far more developed than the rational brain. Thanks to this poor design of the human brain for the modern environment, we make bad decisions which lead to bad outcomes. I can cite scores of examples of bad decisions that I have seen in my long association with the real world as a corporate director, as an advisor, and as an investor. I'll share some of these things as we go along. As I said, even though the rational finance model was the dominant model, there were challenges posed by uh, behavioralists. I would identify 5 persons as the pioneers in this paradigm shift that is taking place in the world of finance. We're seeing a paradigm shift from rational finance to behavioral finance. Herbert Simon was a very eminent economist who got a Nobel Prize in economics. He challenged the assumption of rationality, which was the central assumption of the rational expectations paradigm which dominated the world of economics and finance from 60s onward. He said human beings are not perfectly rational due to cognitive limitations. They are boundedly rational. He also said human beings do not have the computational capabilities to optimize or maximize. They merely satisfies. He coined a new term called satisficing, a combination of satisfactory and maximizing. Then came Daniel Kahneman, a cognitive psychologist. He studied human behavior under conditions of risk and uncertainty, and he found that human beings suffer from a lot of cognitive limitations. They employ cognitive shortcuts which lead to a departure from the rationality as postulated by the rational expectations model. Robert Shiller, an eminent economist, argued that social forces play a very important role. Richard Thaler, a pioneer behavioral economist, argued that we display a lot of mental quirks. And he said very interestingly, we misbehave thanks to these mental quirks or anomalies. Vernon Smith, an eminent experimental economist, conducted various experiments to show that human beings departed from rationality. By the way, all these persons, Herbert Simon, Daniel Kahneman, Robert Shiller, Richard Thaler, and Vernon Smith, became Nobel laureates in economics. In the last few years, Robert Shiller got his Nobel Prize in 2013, and Richard Thaler got Nobel Prize in 2017. That indicates the growing influence of behavioral factors in the financial paradigm. Let me quickly go through some of the seminal works these pioneers. As I said, Simon was the first person to challenge the rational expectation model. He wrote a very interesting book called Mortal Man, in which he argued why we behave in a boundedly rational manner and why we only satisfy and not maximize. Daniel Kahneman, a cognitive psychologist, got a Nobel Prize in economics for having integrated insights from psychological research into economic science, especially concerning human judgment and decision making under uncertainty. He wrote a fascinating book called Thinking Fast and Slow, which has become an international bestseller. I prescribe this book for every course that I teach at IIM Bangalore, even now. This is one of the pioneering works, and I recommend this book to every one of you. It will provide you with a richer perspective to understand the world of finance. In this book, he argued that there are two psychological processes at work in the human mind, System 1 and System 2. System 1 is fast, effortless, automatic, instinctive, associative, emotional, and difficult to control. System 2 is slow, serial, effortful, deliberately controlled, and rational. You may say System 1 corresponds to the limbic system and System 2 corresponds to the neocortex brain. Here are some examples of automatic activities performed by System 1. You detect one object that is nearer than another easily. Discern friendliness in the voice. You answer a simple question like 2 plus 1. System 2 requires attention, voluntary effort. For example, you invoke System 1 when you have to identify the clowns in the circus. Discern the voice of the friend in a crowded and noisy room. Calculate the product of 93 and 37. Pick pose in a complex argument. System 1 is fast, unconscious, automatic. It is being employed in everyday decisions and it is prone to error. System 2 is slow, conscious, effortful, difficult requires complex analysis, and it often results in accurate outcomes. Since we employ System 1 most of the time, we are cognitive minded. We resort to cognitive and emotional shortcuts. In a typical day, we may take 30 to 40,000 decisions. If I'm moving my finger, I'm taking decision. If I'm speaking to you, I'm taking decision. If I'm moving my arm, I'm taking decision. If you analyze your daily behavior, you take 30 to 40,000 decisions. Most of these decisions are taken by the processes in System 1, which are automatic. They lead to certain biases because the mental shortcuts that we employ, we commit biases. Cognitive psychologists and others have identified a number of departures from the model of rationality, and they have found there are close to 200 such biases. There is extensive literature on heuristics and biases. I would like to focus my attention on 7 such biases which have been identified very well by Aberdeen Investment, which is captured in the word mirrors. Uh, M stands for myopic loss aversion. We display a lot of myopia or short-sightedness. We are loss averse. Losses hurt us much more than gains benefit us. Integration. We would like to behave like others. We have strong herd instincts and strong herd mentality. We do not want to be socially isolated. That is why we behave in a manner similar to what others do. Recency. We look at our recent experience and project it onto the future. I mentioned about the extrapolation bias. We ignore the general statistical evidence. We ignore the base evidence. We rely on our immediate past experience to project what is likely to happen in the future. Risk perception. Our risk perception is seriously flawed. We are probability blind. It has been found in numerous experiments that human beings have great difficulty in dealing with risk and uncertainty. Overconfidence. This is a very common trait among human beings. We overestimate our ability. We overestimate our ability to control a situation. We tend to be very optimistic about what we can do. Our results. We rely primarily on the outcomes to judge whether something is good or bad. We don't look at the process. We suffer from the outcome bias. A portfolio manager may have employed a very sound process, but the outcome may be very bad because of bad luck. A portfolio manager may employ a very flawed process, but the outcome may be very satisfactory because of good luck. Remember, the outcome is a function of skill and luck, but we often attribute the outcome to skill. It must be emphasized that luck plays a very important role, particularly in the world of finance and investment. The human tendency to look at results and outcomes causes a certain deficiency in our understanding. S stands for stories. We are captivated by stories. The human brain is evolved to think in terms of stories. Stories are vivid. Stories have a visceral effect. Stories have a stronger neural signature. Statistics and facts are very bare. They don't impress us. They don't motivate us because our brain has evolved to think in terms of stories. We're captivated by stories. These are some of the mental shortcuts that we employ. These are some of the cognitive and emotional shortcuts that we employ that lead to a lot of biases in our decision making. Let me now look at prospect theory developed by Kahneman and Tversky. Prospect theory is an alternative to expected utility theory. Expected utility theory is a cornerstone of the rational finance model. Prospect theory is a very important pillar of the behavioral finance paradigm. The primary difference between expected utility theory and prospect theory is expected utility theory assumes that an individual will evaluate a certain investment based on its impact on his or her final wealth. Everything is evaluated in terms of its impact on final wealth and the utility thereof. On the other hand, the prospect theory argues that we do not evaluate an investment in terms of its impact on the final wealth. We evaluate it in terms of gains or losses in relation to a reference point. Let us understand what it means. Ram currently has a wealth of rupees 100 lakhs. He is considering an investment entailing an outlay of 10 lakhs. This investment can grow in value to 15 lakhs or erode in value to 8 lakhs. Both these outcomes are equally probable. It's a very risky investment in a sense that there is a 50% chance there will be a 20% negative return. If you look at the final wealth that emerges when he undertakes that investment, his wealth of 100 lakhs could become 105 lakhs if the investment has a positive payoff. His wealth of 100 lakhs can become 98 lakhs if the investment tends to have a negative payoff. Expected utility theory argues that this person, Mr. Ram, will evaluate these final outcomes and take a decision. His expected utility would be 0.5 times utility of 105 lakhs plus 0.5 times utility of 98 lakhs because he evaluates every investment in terms of its impact on final wealth. In prospect theory, he looks at gains and losses with reference to his current wealth. He looks at gains and losses relative to 100 lakh, which is his current wealth. He can gain 5 lakhs or lose 2 lakhs. So he evaluates that prospect in terms of its value as 0.5 into utility of value of 5 lakhs plus 0.5 into utility of minus 2 lakhs. This is a very, very significant difference between the two theories. This is how the individual will look at that investment decision in relation to a certain reference point. You evaluate your gains and losses. Uh, the gain can be 50, the loss can be 50. Another very important feature of prospect theory is that the individual displays diminishing sensitivity to gains as well as losses. Because of diminishing sensitivity, the value function is concave in the gains region and convex in the loss region. More important, the value function has a much steeper slope in the loss region and a less steeper slope in the gains region. The key tenets of prospect theory are reference dependent, diminishing sensitivity to gains and losses, and loss aversion, because we have seen that a loss of 100 can cause far greater pain than the pleasure that you derive from a gain of 100. In fact, Kahneman and others said that it is a factor of 2 to 2.5 times. If I have to uh, focus on the key insights of prospect theory, they are essentially three. We experience life in terms of changes. We feel diminishing sensitivity to both gains and losses. Losses sting more than equivalently sized gains feel good. These were fundamental insights which fetched Kahneman a Nobel Prize. My next proponent is Robert Shiller, who got the Nobel Prize in Economics in 2013. Robert Shiller has been arguing that markets deviate significantly from intrinsic values. He wrote a very fascinating book called Irrational Exuberance. Incidentally, and luckily for Shiller, this book was published just a fortnight before the crash of 2000. He was arguing from 1996 onward, the market had become irrationally exuberant, but the market has a tendency to rise to very high levels before it falls. And when the book came out in 2000, the market was virtually at its peak, and then it collapsed, in a way vindicating what Schiller has been saying for so many years. The third major proponent of behavioral finance, Richard Taylor, he wrote a very fascinating book called Misbehaving. Uh, there's another book that I strongly recommend to my students now in Bangalore. Taylor identified a lot of anomalies with departures from rational behavior from early 1980s, but he was sidelined or even ridiculed by mainstream economists who said that he was interested in collecting curiosities here and there. There was no consistency in what he was saying, but Taylor persisted and he found a number of ways in which human beings misbehave. When he says misbehaving, he says behavior will depart from the model of rationality as postulated by the rational expectations paradigm. Over a period of time, he identified a number of such quirks and behaviors which uh, made him a star in behavioral economics. He got Nobel Prize in Economics in 2017, and he was the sole awardee at that time. It's a tribute to a significant contribution. In this book and his other writings, he has emphasized two concepts: mental accounting and self-control. These are very important ideas which have revolutionized our thinking in many ways, both theoretical and practical. Uh, in traditional finance, wealth is considered as fungible. Every decision is supposed to be based on its effects on overall wealth position. I talked about how expected utility theory looks at various decisions. In reality, we don't evaluate every decision in terms of overall gain. As a practical expedient, we separate wealth into various money accounts and treat rupee in one account differently from a rupee in another account. That is how we manage our wealth. We divide our wealth into different buckets and assign labels to these buckets and treat monies in these buckets differently. If you label something as bonus, you are likely to be very spendthrift in spending it. But if you label something as savings, you're likely to be very conservative. This is human nature. It's very difficult for me to evaluate the impact of every decision I take on my overall wealth. So I look at how it impacts different mental accounts and uh, based on that I take decisions. And this is what almost everybody I know comes into doing. Let me now uh, draw a very summary comparison between the rational finance model and the behavioral finance model. The rational finance model assumes that human beings form beliefs very accurately and objectively, and they exercise preferences very rationally. Behavioral finance model argue that human beings are normal. They resort to cognitive and emotional shortcuts and errors. The rational finance model assumes that we are guided only by utilitarian wants. The behavioral finance model says that we have utilitarian wants, we have expressive wants, we have emotional wants. When I make an investment in a company, I'm not guided entirely by utilitarian considerations of rate of return. I would also like to invest in companies which improve the ecology. I would like to invest in companies which do things which are socially very worthwhile. Social investing is gaining prominence. Likewise, someone may derive a lot of thrill and adventure from trading. It satisfies his emotional need for thrill and adventure. He may be fully aware that it is a loss-making proposition, but he undertakes that to satisfy his need for thrill and adventure. Expected utility theory is the central theory of rational finance model. Prospect theory is the central theory of behavioral finance model. The main variance portfolio theory of Harry Markowitz is a very important cornerstone of rational finance model. We have behavioral portfolio theory in which a portfolio is divided into different segments which correspond to different goals or needs. Capital asset pricing model has been infused with behavioral insights to develop behavioral finance model. Efficient markets hypothesis has been enriched to develop behavioral efficient markets hypothesis. Standard life cycle theory has been modified to develop behavioral life cycle theory. This gives an idea about how the rational finance models have been enriched by insights from cognitive psychology, social psychology, and neuroscience to develop richer models of finance. If I have to put it in very simple terms, the rational finance model assumes that people have unbounded rationality, people have unbounded willpower, people have unbounded self-interest. Behavioral finance model says people have bounded rationality, people have bounded willpower, people have bounded self-interest. I have now turned my attention to ways and means of overcoming these biases. I have emphasized that we are not wired for financial rationality. We are prone to commit errors all the time. We have to find ways and means of mitigating psychological bias. I have found in my experience that I have committed most of those mistakes, and the only way you can mitigate those mistakes is when you follow a set of guidelines. These are some of the guidelines that I would like to offer. One, focus on the big picture. When you are managing an investment, make sure that your asset allocation is well thought through. Most of us have priority investments like a residential house, a term insurance cover for the family, a medical insurance cover, and liquidity to meet unforeseen needs. These are priority investments. After that, you look at your financial investments like stocks and bonds and decide on how much of your financial wealth you will allocate to stocks and how much to bonds. Let us say you have 100 lakhs of financial wealth, you may say 50 to stocks, 50 to bonds, or 60 to stocks, 40 to bonds, or 30 to stocks and 70 to bonds. This is a strategic allocation decision. This is the most important decision that you have to make, and this decision has to be guided by two factors: your investment horizon and your risk tolerance. If you have a long investment horizon, then you can tilt your portfolio in favor of stocks. If you have a short investment horizon, then the portfolio should be tilted heavily in favor of bonds. Likewise, if you have a high tolerance for risk, you should tilt your portfolio in favor of stocks. If you have a low tolerance for risk, you should tilt your portfolio in favor of bonds. Rely on words and numbers, not sights and sounds. Sights and sounds invoke the reflexive brain or the mammalian brain. Words and numbers evoke the rational brain. As a matter of practice, I look at the annual report of a company. I try to avoid watching TV shows or listening to anything where you have a lot of sights and sounds. However, I am a human being. Occasionally I do those things, but when you have to take a very carefully thought through decision, rely on words and numbers. They activate the reflective part of your brain, and do not rely on sights and sounds because they activate the reflexive part of the brain. Follow a set of quantitative criteria when you are evaluating any stock. Numbers discipline you considerably. You may say, I will invest in a company which has a good track record, which has a return on equity of more than 15% for the last 15 years, or 10 years, or 5 years, or whatever, or which has grown at a rate of at least 10 to 12% on a compound base in the last 10 years, so on and so forth. These are some quantitative criteria you lay down to discipline your investment decision making process. Diversify. Diversification is the only free lunch available in economics and finance. Make sure that your portfolio has 10 to 20 stocks from different industries. Diversification ensures that you minimize your systematic, uh, you minimize your unsystematic risk. Do not forecast stock prices. I have never come across in my 50 years of experience anyone in India or abroad who can forecast stock prices. Yet we tend to forecast all the time. Human beings suffer from a disorder called prediction addiction. We want to predict all the time. However much I may tell my friends and relatives that they should not forecast stock prices, I get calls from them periodically. What will happen to the market in the next week or next quarter or whatever? This indicates this human desire to forecast. Please remember stock prices behave in a non-forecastable manner and forecasting is a futile exercise. The only purpose of stock market forecasting is to make astrology look more respectable. Control your investment environment. Uh, you may say that you look at your portfolio only once in a month. A very simple thing would to do would be to look at your portfolio just on the first day of every month. Insulate yourself from the noise that prevails in the market. Evaluate carefully your portfolio on that day and take whatever decisions you have to take on that day and forget about your investments for the remaining month. Strive to earn market returns. If the market delivers 8%, 9%, 10%, 11%, you should strive to earn market returns. Periodically rebalance your portfolio. From time to time, there is euphoria in the market, there is despondency in the market. You have to look at your portfolio and rebalance it. Stocks have depreciated very significantly. You may like to invest in stocks at that point of time. Stocks have appreciated considerably. You may like to book profits and switch to bonds. Here are some landmark works that I recommend to those who want to understand uh, more about this fascinating area. I have found all these books extremely illuminating. Marx Man by Simon uh, Kahneman's book Thinking Fast and Slow, Schiller's book Irrational Exuberance, Richard Thaler Misbehaving, Benjamin Graham Intelligent Investor, Jason White Your Money in Your Brain, Nassim Taleb Fooled by Randomness, uh, the letters that Warren Buffett writes to his shareholders. These are some of the landmark works. I have tried to summarize most of these things in my book on behavioral finance, which uh, discusses the evolution of behavioral finance, explains the key insights from cognitive psychology, social psychology, neuroscience, explain the central ideas in the case of behavioral finance, explore ways of injecting greater rationality in financial decision making, draw on the wisdom of a wide range of disciplines. The book is divided into 6 parts, which are mentioned here and available from McGraw-Hill. At this juncture, I would stop and take queries that some of you may be having. You could speak to her and find out what it. Hmm? Yeah. Yes. There are no questions, only many. There are some, but most of them say they. Uh,
Okay, yeah. Okay, right. You send it to the WhatsApp? And
there is a general request for sharing the presentation. I'll be very happy to do that. There is a question by Gaurav Manga. Can you explain a way more in depth about the contribution of Taylor? As I said, the two major contributions of Taylor have been mental accounting and self-control. Taylor realized that individuals do not have enough self-control, particularly in the present moment, but they have enough self-control in future moments. So he thought of a brilliant idea. Let me give an example. He worked with a company. He said, let the employees say whenever they get increment, a portion of the increment would be saved. It is a way by which individuals exercise self-control and improve their investment pattern. This has been found to be very successful. Uh, I would urge you to go through a book called Nudge that Taylor has written along with son Constant and which is considered as a great work of applied behavioral economics. There is a question from Debasis Mohanty. What are the recently identified behavioral biases? Uh, most of the biases, let me uh, answer your question by uh, going through a slide that I could not present earlier. Uh, can you see this slide? There's a very interesting taxonomy of biases developed by Schleifer, another giant in the field, and he divides biases into four broad categories: heuristic simplification or information processing biases, self-deception or limits to learning, emotional biases and social biases. As I said, there are about 200. I have in my book kept about 50 to 60 of the important biases. Uh, and you can go to the work of Schleifer on that. Mr. Devaship Mohanty has another question. Is it really necessary to analyze the behavior of FII and DII before starting investing? Uh, all people are amenable to make mistakes. individual investors tend to make more mistakes. Institutional investors often have processes. You have to find out what is the internal process followed by an institutional investor. Of course, they have their biases, but their biases are substantially mitigated by sound internal processes. Any other question? Hmm? Here is a question of by Mr. Vivek Date, how far behavioral science relevant to infrastructure project formulation and PPP structuring? One of the biases that has been identified by behavioral finance is overconfidence, and we have seen how a lot of these projects have uh, uh, represented misallocation of resources because people were overconfident in some way or the other. Uh, I should mention a very conspicuous example of Tata Power's uh, ultra mega power project in Mundra, when they, out of overconfidence, agreed to supply power for 25 years at a rock bottom price. This is a manifestation of this phenomenon of overconfidence leading to a wrong investment decision, which has hurt Tata Power very, very significantly. What? Uh, Dharmender Rai, what are the latest, sorry. Okay, it's time to close. Thank you once again for your patient participation. I thoroughly enjoyed doing this session. And if you have any queries, do write to me. I'll be very happy to respond to them. My email ID is Chandra, Chandra, at cfm-india.com. You will find it in the preface of any of my books. I've had a long association with McGraw-Hill. I've done uh, uh, 9 books with them over the last 40 years. And in any of my books with McGraw-Hill, you will find my email ID, and do write to me. Uh, I'm thankful to McGraw-Hill for organizing this webinar. My special thanks to Prakriti Kapoor, who nudged me into doing this seminar and kept the eye constantly on ball. Thank you, Prakriti. Thank you, everybody.